What's up, Finance Fam? In today's video, I'm going to be answering the age-old question, should I buy the stock market right now? I'm also going to fill you in on what I'm doing in my own portfolio right now. So it looks like we're facing the most predicted recession that is supposed to hit us. Everybody's on board. Everybody is saying recession is coming, and that's leaving a lot of people putting pause on their plans to invest more money into the stock market because a lot of people are afraid that the stock market is going to quote unquote crash, whatever that looks like to you, right? To me, a crash is basically we're looking at 30% or more in the stock market selling off. That is a crash. A lot of people expect more turmoil ahead. So it begs the question, what does one do when everybody is saying we're going to be seeing this recession? Are we actually going to see the recession? And how am I supposed to position my portfolio for this, right? Like, I don't want to keep investing money if the stock market is going to continue to crash further. That's what a lot of people are thinking. Now, I want to dive into some data. I want to dive into my thoughts, how I'm processing if I should be investing in the stock market more right now or not, right? As I've talked about before, the stock market prices itself based on corporate earnings. So, us being out in the economy, spending money. If we're not out there spending money, corporations are not profiting. Therefore, the stock market does not do well. If a recession comes, obviously, we're not spending as much because a lot of people are going to be unemployed. They're not going to have income. They're not going to spend. That's why a recession is very, very bad for the stock market. So that's why when we see a recession, which is going to be represented by the gray shaded areas here, these are prior US recessions. When we see these recessions, we see these stock markets sell off. You can see this is a chart of the S&P 500. The purple line is price of the S&P 500, and price goes down during these recessions because people aren't spending money. So back to earnings growth and why earnings are really so important. Corporations are really going to dictate what happens going forward. And we have some insight into what 2023 is going to bring in terms of how corporations are going to fare and profit. This is where I think things get a little dicey because it has been doom and gloom in the news for a very long time. We're going to see an earnings recession. We're going to see an economic recession. The Federal Reserve is going to continue to raise interest rates. But what we've really seen actually happen has been so far, the Federal Reserve has raised interest rates, as you know, if you've tried to go get a mortgage. What we're experiencing is an actual holding up of the economy that I think a lot of people didn't really think was going to happen. A lot of people thought the economy was going to fall flat on its face, and that's not happening because of the labor market. Our unemployment rate is 3.4%, which is the lowest it's been since the 60s. So, in order for the economy to fall flat on its face, we need to see people not be employed, right? And that's not happening, which is good. I think that what we've seen has been maybe the best case scenario where the economy is just kind of humming along. People have jobs, people can at least pay their bills. Maybe they're not thriving because of inflation, but they're getting by. And so, what we're looking at is actual earnings growth for 2023, which a lot of people did not have on their bingo card. Let's talk through a few scenarios that could either bring the market down or make the market kind of stay where it is. So this is the Yardeni earnings forecast report. We can see historically what earnings have done every single year going back to 2009. So when I'm looking at this report, I'm looking at what Yardeni is estimating the earnings are going to be versus what the consensus is, meaning all the other analysts, right? The consensus of all of those analysts out there at the big banks, etc. What are they estimating earnings to be for the year versus Yardeni, what Yardeni is estimating the earnings to be? And, this website is absolutely a wealth of information. Highly suggest it, yardeni.com. Thank you, Yardeni. The thing that I want you to look at here is we don't fully know what 2022's earnings are going to end up looking like because we're still getting earnings reports that are reflecting the last quarter of the year for a lot of companies. So it's still in process, but as of right now, knowing the first 3 quarters of earnings, the estimate is about 219 for the earnings per share for the S&P 500. This is how we, figure out how expensive or cheap the stock market is by knowing the price of the stock market and dividing that price by the earnings per share that is estimated for that given year. That's how we get our price to earnings ratio, which tells us if the stock market is expensive or cheap. And I have videos describing this, explaining this, but that's the general idea here. So what I want you to notice is that right now, for 2023, there is estimated growth in corporate earnings. So we don't know where 2022 will land, but as of right now, it looks like estimates are showing we're going to see between 0 and 3% earnings growth for 2023. Now, you might be thinking, well, that doesn't sound very great. Well, actually, considering how negative people were about how 2023 was going to end up looking, I personally think that that is actually a win. But we also have to remember that if we look back at 2022, we had earnings drop 14% and then grow almost 50% in 2021. So that was a lot of volatility. So the way I'm looking at it is basically if we do see 5-ish% earnings growth for 2022, we're normalizing. We're kind of normalizing after a very, very turbulent time that we went through. So, really, the wild card here is if the Federal Reserve raises rates too high, and that is what ends up breaking the economy significantly and keeps them high for a very long period of time, that's where 2023 may not shake out as people are expecting, and things may be worse. But as of right now, assuming the worst case scenario that we don't grow earnings at all, we have flat earnings growth, 0% earnings growth, we I think could see the market hold up on that news alone. So back to the question, okay, well, that's great, but should I be buying the stock market right now? Well, I wanted to point one more thing out. I have been talking about something for a long time, since middle of last year, probably, that I think we're in for a range bound, choppy stock market. I don't think that we're going to see significantly lower lows in the stock market from the low we've seen. And I also don't think that we're going to see a major rally in the stock market in 2023 that can be sustainable, that can hold. I think we could rally, but I don't think it's going to be very sustainable. So I found a slide in the Ardini report that I wanted to point out because it really does align with what I have been saying since the middle of last year. And so what we're looking at here is the forward estimates of what the S&P 500 PE ratio is going to be. Remember, I told you the PE ratio is what we use to decide if the stock market is over or undervalued, and you get that by knowing what the price of the stock market is, and you divide it by the earnings per share of the S&P 500, right? We're all talking about the S&P 500 across the board here. So 2022, based on what we are estimating for the earnings that we're still getting for 2022, the range of the PE is basically going to be between 15 at the low and then 18 at the high. We're a little bit above that now, but we're still in that 18-ish range for the PE. So that has been the range that we've been in terms of valuation multiple for 2022. For 2023, this is the green estimating the range of the PE ratio that we're going to see for 2023. And you can see it's not that much different from 2022. We're continuing to have a floor no lower than a 15 PE, and the estimate on the high end is around a 17 PE. So basically, that continues that idea that we're going to be in this kind of range-bound, choppy market. And then for 2024, things start to look up a little bit, which we're all expecting, coming out of 2023. Basically, we're going to see growth on the back half of 2023. That's the expectation. And then pick back up into 2024. The economy kind of picks back up and continues on its way. Now, 2024, the floor, the lowest PE ratio we're thinking is 16, and then capping it at 18. So the market is really being pinpointed into this range. So, what are your options in a situation like this where we are expecting a range bound choppy market that's really not going to do a whole lot over the next year, possibly 2 years? Well, I think that all is not lost. And I also think that if you have a long term time horizon, you shouldn't be thinking about this too much because remember, we are thinking about the future. We are thinking about future growth, future innovation, future technology, and the stock market, basically is something we invest in because we think the future is bright. Don't overthink it too much. I personally think that a lot of the information and data we have right now is sort of pointing us to maybe the low of the stock market is in, or at least we're close enough to it to where, you don't want to be getting too caught up in the weeds on, oh my gosh, should I be putting my money in the stock market now or not? Right? Think about your goals, think about the long term. People have jobs. Inflation is a real pain in the butt right now, but we're hoping as the Fed continues to raise interest rates, then maybe that'll slow down some of this spending. But that is really yet to be seen. People are still spending money. The economy feels like it could really chug along in a Goldilocks way, like not too hot, not too cold. And that's what's going to keep the stock market from having this 20, 30, 40% huge sell off, even lower from the lows that we've already seen, which a lot of people thought was going to happen. And I was always saying you need to be prepared for both sides. You need to be prepared for all scenarios. And this is exactly why, right? People that were sitting around waiting for this big, massive crash to come below the lows we've already seen in the S&P 500 in 2022, they're sitting around watching the stock market look like it's about to rip now and go higher, not sure what to do now. And they may end up FOMOing, fear of missing out into the market because of that. So you have a few options. I think that right now, continuing to invest in the stock market is not a bad thing to be doing. If you have a long term time horizon, absolutely, definitely not a bad thing to be doing. Don't get too caught up. But there is something interesting happening right now in the market that hasn't happened to a lot of people that have not been investing for a very long time, particularly millennials. You can actually get yield, aka interest, on your cash, on your money. Like saving is actually paying right now. You're being paid to save. And that is something that we haven't experienced because interest rates have been so low for so long. And this is one of those things that's great that you can get paid for saving your money, but it's also one of those things that's not great for the stock market because if people can get paid to save on their money, they can get paid 4 or 5%. They're not going to want to put risk in on the stock market. They're going to be more conservative instead. So it's got, its pros and cons, this discussion on getting interest on your money. But for the most part, it's giving people optionality that they didn't have before. So, what we're looking at here is a chart of the 2-year Treasury rate, which is the orange line here, and the 3-month Treasury bill rate, which is the purple line. So, think about it this way when you are investing in a bond, right? We'll just say bond to keep things easy. There's bills, there's notes, there's bonds, but we'll call them all bonds just for simplicity. You're taking on interest rate risk. You're taking on the risk that interest rates change significantly in either direction, which could be good or bad for you depending on when you bought the bond, right? So if you buy a bond and interest rates go down, you did a good thing because you are locked in on this bond at a much higher interest rate. And now interest rates are going down, but it doesn't matter because you're locked in on this beautiful high interest paying bond, right? So that's good. You won. But the opposite can happen. You can end up buying a bond at a rate and then interest rates go higher and you want that higher rate, but you can't get it because you're stuck in this bond at the lower rate. So that's kind of how bonds work and what interest rate risk is. So, in order to combat interest rate risk that you have when you buy a bond, you can utilize different maturity rates, right? You could maybe, instead of doing a 2-year bond, you could do a 3-month Treasury bill. And a lot of people before wouldn't have really wanted to do that because the longer you lock in, the higher the interest rate is going to be. But now things have changed. We have an inverted yield curve, which means that you can actually get paid the same amount or even possibly more in interest by having a shorter time frame. Yes, so a 3-month treasury bill rate is actually higher right now than a 2-year, not by much, but what I'm saying here is that you're getting paid the same amount by taking less risk in terms of how long you have to hold that bond. The shorter of a time frame that you have to hold it, the less interest rate risk you have. So right now, this is a very unique scenario, and we can look back historically, and you typically see that the 2-year rate is going to be higher. Typically that's how it works. The 2-year is going to pay you more interest than the 3-month because you're locking in and taking on that duration risk. That's not to say that when you're buying a bond, you should always take the shorter time horizon, because that's going to be less risk for you. There might be times where you want to consider locking in an interest rate for 2, 10 years, right? 10 plus years. If you know that you can lock in a 10-year treasury bond at 4%, right? And you would rather take that 4% over 10 years versus risking having to have a T-bill mature. And then what if interest rates are a lot lower after that? What if the Fed starts to reverse course and decreases interest rates, right? So you have to manage the goals and choose what's going to work best for you. But right now, in today's environment, for a lot of people that are hesitant about putting money in the stock market, they do have this option of being paid on their cash, and a pretty decent rate, mind you, right? Considering what we've seen over the past decade. You could see interest rates have been basically zero. Starting in 2016, the Fed started to raise interest rates, but it didn't last very long. The stock market didn't like it very much. And, we ended up seeing interest rates right back down to zero when the pandemic hit. So seeing this fast of an interest rate rise and yields being this high, it's pretty surprising, and a lot of people haven't experienced this before, to be able to be paid on your cash like this. So it's an option that I'm actually utilizing right now, keeping some money in cash, taking advantage of that higher paying savings account or higher paying, treasury bill or note. And then I'm also investing at the same time in the stock market. I'm doing a mix of both because I do think that, there is still opportunity out there in stocks that I want to take advantage of when these prices are depressed. There are a lot of stocks that sold off way more than the stock market did. So there's those individual pockets of opportunity. I'm also investing in my funds. I put in a chunk of money in my passive funds just a month ago, but I've also kept an amount of cash in my portfolio while I wait out and kind of see what's going to happen with earnings going into 2023, because there are still a lot of unknowns. There's still the Federal Reserve continuing to hike interest rates. It's not breaking the market yet, but that doesn't mean that the market can't get a little weak in the near term. So I'm trying to manage all of that as carefully and thoughtfully as I can. If you're not a big risk taker to begin with, then definitely something to be considering buying certain types of treasury maturities, whether it's a shorter maturity because you don't really want to put your money in the stock market yet, but you'd like to earn something on it. Then, there's the opportunity with the 3-month treasury bill, for example, or a money market fund that might be paying a pretty nice yield right now, a money market mutual fund. So you could do something like that. Or you may even want to reduce some risk, some longer term risk, as interest rates are going up over the next few quarters, which looks like they're going to continue to keep going up and stay elevated for a while. You may want to start thinking about what bonds look like in your portfolio, or is there an opportunity to maybe add some bonds to the portfolio? It's actually starting to look like bonds are cool again, and there could be some opportunity for you to reduce some risk in the portfolio, get some yield. And if you're not really much of a risk taker to begin with, then this could be a time for you to analyze that and restructure, reallocate the portfolio for the future. So, just some food for thought on that. I personally am continuing to invest in my passive funds. I'm continuing to invest in individual names. I'm continuing to have cash on the sidelines that I will deploy if we see the lows retested in the stock market. I'm definitely not in the camp that I need to wait a long time to see the stock market fall on its face and we see like a 2008 style sell off. I don't think that that is likely to happen unless we have some scenario pop up that none of us could foresee. But the moral of the story here is that you saw the range that the market is estimated to kind of bounce around in. And is it really going to make you or break you if you wait to buy stocks for a month or two or four or six, right? Like, have a strategy. Maybe you dollar cost average in over the next 6 to 12 months because of all the uncertainty. Maybe you take a certain amount of money every single month and put it in the market over that time frame so that you're not having to really think about trying to time what the market is going to do. But it's choppy, it's range bound. I don't it's not going to make you or break you in another 5, 10, 20 years, so to speak. Unless something drastically changes. So that's my take on earnings. That's my take on the bond market right now. That's my take on where I think price could go from here. Smash the like button for me if you enjoyed this video. Go ahead and subscribe if you're not subscribed. I talk about the markets. I respond to TikTokers giving out terrible financial advice so you don't get trapped. And I talk all things personal finance. I'm just trying to make you a better investor and manager of your money. I'll see you next time.